Hello everyone, welcome to the Columbus Multifamily Investors Meetup. Thank you all for coming, and my name is Matt Engel, I'm the host, and tonight we have Matt Drane as our distinguished guest.
Good evening, everybody.
And Matt's going to kind of walk through the differences between a Proforma and what's really going on in the property. So Matt has had a long career in the commercial real estate industry, and he's here to share his experience with us, and we're grateful for that. So,
Thanks, Matt. Appreciate it. Thanks for having me. Excited to join you all tonight. And as Matt said, I'll look at this topic. I know it's a pretty broad topic, right? So pro forma versus reality. My background is primarily investment sales brokerage. So throughout my career, I've sold a lot of apartments, which means I've underwritten a lot of different deals. So what I've learned from that, I'll first kind of tell you a little bit about myself, right? So, I'm a Cincinnati kid. I live here in Columbus. Started in real estate in 2004 in single families, like, many people do. And I realized around 2010 that I wanted to own apartments. So I wanted to own apartment buildings. And that's where I realized the best path to probably ownership is to learn how to broker, transact, and underwrite. So in 2012, I started my business, grew a pretty good market share within my territory. I lived in DC for about 15 years, so most of that time was spent in Hampton Roads, Virginia. Built out a team. We did about 450 million in transactions, all of small apartment buildings. And what I mean by small, I say private client. So those assets that would trade between $1 million in value up to, at the time, $30 million or so was kind of the high end range of that track record that I have. So I learned how to broker, did pretty well, hired people, trained them on how to broker, they did pretty well. And now I live here again in Columbus, husband, father of 3 boys, and I work for a company. The name of our firm is Greysteel. We're a national brokerage platform, again, focused primarily on investment sales, capital markets, and also, I would say, structured finance. So for those of you who are already in the apartment ownership business and you have a portfolio and maybe you're scaling that portfolio, we do assist on debt as well as JV equity. So if you're looking to do a deal and you're looking for a single check writer, family office, $1 million, we can help with that as well. So that's kind of the context and the background. But yeah, so the topic, pro forma versus reality. I'll get to this topic in a couple of different ways. One lens will be as a buyer, because I know I personally have acquired deals based on assumptions that over time drastically changed, right? So one thing that I'll look at is, how do I look at a deal as a buyer? I also will look at this and discuss as a agent, how can you better prepare your client, your seller, and manage their expectations on underwriting? Because oftentimes, hey guys, oftentimes their understanding of what the numbers are very different from what a new buyer will experience. So I'll kind of go at it from a buyer's perspective, a agent's perspective, and then also just, I'll criticize a few of these packages because I think we've all seen offering memorandums from brokers that probably aren't intentionally misrepresenting the deal, but if it's underwritten poorly and it's not defendable, one could argue that the broker is not doing their job. So I have a deal here. It's in somewhere in North Carolina. Like I said, I wanted to pick a market that was not too close to home. I wanted to pick a market where we could actually critically pick apart a deal. So this is the deal that we'll go through. And Matt, if you don't mind going to that PDF behind, I'll basically just go through the same training that I share with my advisors and my team. So how do you look at a deal from a financial standpoint, and all the different parts of that deal where I see common either mistakes, common misrepresentations, or just overall things that are missed throughout the process, right? So looking at just revenue, so top line, how do you get the income, right? So the first thing that you always want to just verify when you look at a rent roll is, what is the actual in-place rent? Because again, pro forma versus reality, you'll see a package that has let's just use easy math, right? 1,000 is a 10-unit deal. $1,000 rents in the package, right? And they can justify it all they want with all the rent comps that support $1,000, but you actually look at the rent roll and the average in-place rent might be $800 per unit per month on average, right? So you want to just start at the top line. What is the gross potential revenue? So in that case, the gross potential might very well be $1,000 per month per unit. But lenders lend on actuals, and most savvy and or experienced buyers will underwrite to the actual income, the actual adjusted NOI, not the seller stated or the Proforma. So starting from the top, what's the gross potential rent? And kind of just looking down from, where do you go from there, right? So if all units were at market rent, what could that potential income be? But then looking at, the actual rent roll, what is that delta between market and in place? And I'm gonna pull up the rent roll. We're gonna go through the T12 and go through the expenses and actually see, how I'm arriving at my adjusted NOI. But you really just kind of work down, loss to lease. In that same example, if there is a market potential rent of $1,000 per unit per month, but the owner is only achieving $800 per month, that's a $200 loss to lease per unit. So on that 10-unit deal, you're looking at a monthly loss to lease of $2,000. Annualized, you're looking at a monthly loss to lease. That adds up. That's $24,000 in loss to lease. So let's go back to that. Let's actually pull up the actual rent roll, which is, there you go. So before we go any further, just looking at the actual rent roll, scroll down a little bit, if you don't mind that. So these rents, I believe they're all the same unit type. And you can see there are some rents that are at $650, others are at $795, right? So in that same asset, there's a pretty wide spread between potential rent. How do I determine what the potential rent is? I usually conservatively look at the building, right? So the building itself, if there is a unit and they're all the same, and there's a unit that's achieving $795 in rent, and there's other units at $600, I'm not quite worried about what the market is doing. My first order of business is to get the in-place rents at the same building to the same level that's being achieved in that asset. I'm gonna pause for a moment. I know I'm kind of just breezing through it, but just so far, comments or questions on how I begin to unpack what the broker stated pro forma or financials are relative to the actual numbers.
Maybe this is jumping ahead a tiny bit, but how would you factor in property management on when, let's say a seller's NOI says that doesn't have it because they self-manage, they don't have property management, but if you're buying, and same vice versa, it's like, as a seller, I probably would not report property management fees if I'm self-managing.
No, it's a great question, and basically, that's the big takeaway from tonight, right? Because the seller's actual financials and stated financials, I don't think people are bad, right? I don't think sellers are trying to misrepresent, but they want the highest NOI because that's in their best interest. The reality of it is the agent, the advisor, the person that's representing them in that sale is going to have the same objections from the market regardless of what the seller says. So if it's a deal that requires management, and even a lender is going to put some form of management fee into their underwriting. So it's not even an argument as to is someone going to add management into these expenses. It's just a question of how much and how do you justify it. As a basis, anything that a broker puts out should be documented in terms of how they arrived at their assumptions, right? We've all seen packages that either have no financials or have broker stated financials and pro forma with no assumptions and no context. It does no one a service to have financials with no background and no information on how you arrived at it. Because as a broker, that's my defense. I can at least, defend that to the market if I've clearly explained how I arrived at my underwriting. So yeah, so a seller's gonna say, look, I self-manage. If a seller's on that deal for 20 plus years and maybe they bought it cheap and they paid it off and they don't have any debt, guess what else they might not have? They might not even have insurance, because lenders are gonna require the insurance, not every operator and every seller, right? So you can go down the line in terms of what a seller and owner will say they don't pay and they don't have. That's the art of brokerage, quite frankly, in getting that seller to understand that the market has an expectation that they can either decide to meet up front and acknowledge that the market is going to make certain adjustments to their numbers and underwriting, or decide to meet it on the back end when the market will speak for itself and offers will come in much lower because the market is going to factor in certain expenses. What's the one biggest thing that we're going to spend probably 5 to 10 minutes on today discussing in today's market relative to underwriting? What do you think?
Interest rate.
That's one. Property taxes. And you know why, right? And I'm going to show you the property tax bill for this deal, and I'll show you the pricing guidance.
Because it jumps into
Yeah. So, go ahead.
Yeah, I have a question on for like minority partnerships on
Yeah.
some of those proformas. You're gonna see where, I don't know, there's a few partners and maybe one's like the minority partner, so they'll like be charging them about 6% or something like that, something smaller.
Yeah.
You see a lot on things like that as far as not seeing it, but they'll try and, put it down and to see like it's operating a little bit higher.
Yeah, 100%. That's so before we leave the rent roll, I'm going to just call out a few things, and I actually have an 80 unit rent roll that we can walk through, but learning how to read a rent roll is pretty important to underwriting, right? So that first column with revenue, that is the rent. So that is the in-place scheduled or current rent. The second column, I believe, is security deposits. Maybe scroll up to the top a little bit. Yeah, so that's security deposits. The move-in date, and then the past due. So if you scroll down to the bottom, this one is 88% occupied. It's bringing in $16,698 in scheduled or potential rent based on the current leases, and there's $9,909 in collections or delinquency. So let's hop back to my PDF and to my underwriting manual, please. Yeah, there you go. So still walking from the top and going down, we talked about loss to lease. So we talked about that delta between, what the market potential rent is, and also, quite frankly, the loss to lease based on the actual in-building comps, right? Meaning there's just a unit or several units that are renting below the in-building comp or highest rent, or the market potential rent. Go ahead.
Yeah, so it's kind of hard to piggyback on what he was saying, and I'm jumping ahead, but it's an actual situation where this lady owned the building for like 30 years.
Yeah.
She's not real tech savvy.
No.
They got a couple file cabinets with receipts. You don't have too much information. How you guys handle the actual in those cases?
Yeah, so it's a couple different ways to handle it, right? You can ask that owner for as much detailed information as they're willing to share. So, tax returns would help give you at least the gross rental revenue numbers. It will give you some idea of the rolled up expenses. But the reality of it is you might have to make assumptions. If she operates on a, back of the napkin or handwritten rent roll basis, that's okay. I think if are you representing this owner? Or okay. So if she is being represented, yes. So if she is being represented, that listing agent should be preparing her for what is going to happen, which is a lender is not going to give the same credibility to the financials that are handwritten, not organized. So there's going to be a slight discount because the lender's going to look at it a certain way, and then the market, of course, is going to look at it a very different way. And it's not terrible. If she doesn't have organized financials, that's okay. but you have to document at least arrive at revenue. So step one is still, what is the top line? What is revenue? What is income? And she can probably calculate that by going unit by unit, or if she has a lease, you just take the lease value or the rent or the face value based on the lease as your by unit revenue. So that's how I would do it. And I'll keep hopping down. So you look at the loss to lease, other income, that's things like pet fees, parking fees, laundry income, exactly. If there is utility income, so let's just say per the lease, the tenant is responsible for paying a portion of, water, a portion of, the sewer bill. That could be other income as well. But here, gross potential income is basically the sum of all those things from market rents, gross potential, loss to lease, and other income. That is truly your revenue, right? That's your top line. Vacancy. So anybody remember what the physical vacancy was on that rent roll?
50%.
Yeah, so I think the occupancy was 88% per the rent roll. It's an important distinction. Vacancy, you have physical and you have economic, right? So we've accounted for the loss to lease in that first portion. So a unit had a rent of $600, but in that same building, the same unit's renting for $795. So we've already identified a $195 loss to lease on that one unit. So there's a lot more, but we've already identified the loss to lease. Now we got to talk about vacancy, right? So physical vacancy. I don't care how big or how small the deal is. You'll have an owner that says, but I'm 100% occupied. Well, guess what? If it's a 4-unit deal, that's actually worse, because what does your vacancy drop to when one person moves out, right? If it's an 80-unit asset, you have a little bit more, economy of scale. But pro forma versus reality, I know of some buyers who will say, I'm going to write a 5% vacancy on a 4-unit deal, and that's okay. But the reality of it is, you have one vacant on a 4-unit deal, and it takes you longer than expected to turn. That vacancy really has to be underwritten at a much higher, value, right? A much higher percentage, right? So physical vacancy is one component. So on that rent roll, we had an 88% physical occupancy, so 12% vacancy. What else did we notice on that rent roll? And we can maybe pop back, Matt, if you don't mind. So we had a 9,900 past due balance, right? So I would consider that to be economic loss, right? So that's economic vacancy. So again, 2 buckets: physical, which is the actual occupancy, so who's actually in a unit right now and who's not, and then you have economic loss. So again, if you're underwriting this deal at a 5% vacancy because that's what the bank requires, you're already in a hole because you have not accounted for the actual occupancy and the actual economic vacancy, which is the collections. So scheduled rent is what the lease says. Collected rent is what you actually get and deposit in the bank. I've been doing this for 12 years. I've yet to see a building where those two numbers are always the same. Regardless of how big or small the deal is, regardless of how sophisticated or unsophisticated the owner is. It just, there's a delta between scheduled and collected. Go ahead.
What about, how do you factor in leases that aren't necessarily up to market, but for like pro forma ones that are, leases already signed, deposits are in?
Yeah.
How do you guys factor those different than just the market ones?
Yeah, so it often depends on the management style and the operations, right? So if that lease is gone to month, you would probably have a business plan to go to those tenants and propose, hey, we'd love to have you stay, but we need to put you on, longer term leases, and you would renegotiate what that rate is, right? But in the underwriting, that's exactly what we're talking about. So 2 things have to happen. For you to raise that rent, that tenant has to either agree to a new lease and new terms, or you have to go through the process of getting that tenant out of that unit. Go ahead.
I meant for like specifically more like student housing for when the leases are locked in now for the following year.
Okay.
So you're writing those out at the
Yeah. So In a more detailed model, you would have growth rates. So you would have growth rate assumptions, and again, it goes back to those notes in the underwriting. What are you estimating your rent to grow at year over year? And then also, what are you estimating your expenses to grow at year over year? Right now, we are definitely in an inflationary period. It would be pretty irresponsible as a buyer to underwrite a deal without at least a 3% growth rate for expenses, right? So let's pop back. Now that we kind of see the actual rent roll, I would love to go back to that offer memorandum. And again, I picked a deal that was out of market for 2 reasons. I didn't want to pick a deal that someone's actually underwriting right now and trying to buy because I thought that might be pretty cruel. But yeah, let's scroll down. So let's pop all the way down to like the financial. Great pictures, pretty package. Guess what? None of that stuff matters. This is what we care about, right? So we're showing, all right, yeah, perfect. So this deal is actually underwritten well from a standpoint of it's showing the true income, right? Like it's showing the loss to lease. So if we remember, the in-place rent was what, about $16,600 per month? So if I take that by 12, I get $199, right? So they're actually showing the actual total revenues, which is great. But let's scroll down and actually see the by the unit rental breakdown. Should be. Is it not in there?
I don't think so. It's on the right.
Per unit. I was looking for maybe like the actual rent roll, or where the broker will say, X amount of units, monthly income is this. This is one area where you often see that pro forma stated versus the reality. Meaning oftentimes you might see if there's an average, how many units is this deal? 24. So oftentimes we'll see, so it's an average in-place rent of $691. This is oftentimes in the broker's package where you will see that by unit breakdown and it will say $850, right? So they're marking to the highest rent in the building or to a market rent comp. But again, everything else is going to be off if they're starting with a inflated revenue. So what else do we have? So loss to lease. I think they accurately reflect the loss to lease. What are they probably not showing based on the rent roll at least? The collections, right? And I was looking for maybe a vacancy. So they basically are showing.
They show total collected rent.
Yeah, they show total collected rent, right. And that's based off of the 2022. Let's pop down to the T12, if you don't mind. Or there should be a year-end 2022. Yeah, that works. So here's the other thing, right? When you look month over month, some months you have rental income of $15,600. Some months you have $18,555. I would imagine those tenants caught up. January is probably the worst month of the year for collections, right? Holidays, ball out, presents come up short, right? So January is usually the weakest month for collections. But look at that. I mean, there's a lot of fluctuation month over month. So again, I'm gonna present this in terms of a couple of different lenses. If I'm the listing agent, I want to understand any anomalies in the actual year-end financials. So if I see that a water bill for a particular quarter spiked and is 4 or 3 times the average water bill, I'm going to ask the owner about that. I want to know, hey, what happened? Oftentimes they'll say, oh yeah, we had a massive leak, and that's why the water bill is high. So this is the art. When you see an outlier and you can justify it, you can then document it in your assumptions and say, I've reduced my water expense to this number due to an irregular event that is not reoccurring, that's been remedied, right? So that's just good brokerage. That's not misrepresenting the numbers. That's just good brokerage. but you have to explain it, right? What else we have here? If I go back to my broker book underwriting stack, we're now at the part where we are looking at operating expenses. So you can scroll down a little bit. This is basically what you need to underwrite a deal. You need at minimum current rent roll, a trailing 12. T12 simply stands for a trailing 12-month, income statement, so income and expenses. You would love to have, loan information, but as I scroll down, this is really what matters, right? So when
Are you going to send us this document?
If you come work for Greysteel, you can learn. You can learn all of this. It's the same thing that you would get if you Google it, right? Like if you Google multifamily underwriting, same stuff. I can't share the company docs, but I can certainly. You got my card, right? Yeah. I'll email you something. But this is the heart of it, right? This is where you start to basically break down the actuals, and the next step is just identifying the outliers. So we already talked about real estate taxes. You mind pulling up the tax bill? So, yes, $15,000. Yes, that is what they currently pay in taxes. What is the assessed value? The assessed value is $1.1 million. Let's pop back to the OM. So if I go back to the OM, right below it. All right. So taxes. Taxes are flat, right? So the reality of it is, at some point, and I don't care if you do a drop and swap, entity, transfer, whatever you want to call it, at some point those taxes are probably going to, what's the purchase price? Sorry to have you hopping all over the place, Matt. Oh, that's what I was looking for. Yeah, so that's what I was looking for, right? Let's stay here for a moment. So the actual average rent is $691, right? We did the math, right? The rent roll as it stood today, the gross rent or the scheduled rent was $16,600 some change. It's a 24-unit deal, so that math comes out to $691. In the package, they're showing an average rent of $750 for current, and they're showing a pro forma rent of $795. There's only 1 or 2 units in this building right now that are achieving $795. So I'm telling the secret, right? Like, if you're a buyer, you need to know this stuff, but you have to verify the broker's pro forma and the broker's numbers to the actual financials. So from this point forward, everything else is wrong, because everything else to arrive at their NOI is based on revenue that is not consistent with what the rent roll shows. So this is kind of the heart and the theme of the topic, which is the pro forma shows well of $795. What do you have to do to this building if you buy it tomorrow to get all units to $795? There's one of 5 things you have to do. So first off, you got to either get people out or get them to sign a new lease, right? To get them to sign a new lease, most tenants are going to say, hey, I'm happy to pay $200 more per month. I'm being sarcastic, right? I'm happy to pay $200 more per month, but they're going to probably ask for something, right? And rightfully so. You can't just magically move a number overnight without either vacating that unit. What does that do to your 5% vacancy estimate? Well, yeah, you can't have a 5% vacancy if you just move out 12 of the 24 units, right? So on an annualized basis, what does that vacancy really look like now? North of 20%, right? All right, great. So you have people out of the building. What do you have to do now?
Turn.
Yeah, you got to turn it, right? It costs money to replace flooring. I'm sure, it looks like there's some nice units here, but I doubt all of them look like that. So you're going to have significant repair and maintenance. Let's scroll down. I'm sorry. I'm all over the place, but I'm trying to illustrate a point here. Let's go back to the Did anybody catch what the pricing was?
Do you recommend walkthroughs to verify the condition of each unit?
Yes. Anytime you go to contract on an apartment deal, you should specify and require that you have access to every single unit. All right, so where's the maintenance here? They have $9,000 for repair and maintenance. Who owns any type of property right now? Single family, multifamily, doesn't matter. All right, what's the average cost to replace a water heater installed? Not you. I know you get the hookup. I know you get really, really good pricing, but
Like, it could be like $1,300, $1,400.
yeah, $1,300. If you have to replace flooring, a 900 square foot carpet, that's cheap, right? It's the cheapest thing you can do. We're not talking about like LVP. Like, what's it cost to replace carpet in like one unit?
They're going for like $2 and we get it $2.08 square foot. So.
All right, so like call it 1,800.
Yeah.
1,800, right? So right now, between a water heater and replacing carpet in one unit, we're already at $3,000, right? There's no way in the world you can run a 24-unit apartment building or community on $9,400 repair and maintenance. So let's just kind of pop down and start going line by line. I'm gonna just reference this page to give Matt a break for a while. Then I'm gonna go back to the actuals, right? So, insurance. I have the privilege of being able to do deals and work with our professionals across a lot of different markets. One of my advisors, he's in the Mississippi market, right? Historically known for, some bad weather, right? He's dealing with an owner right now whose insurance has increased 12%. His property and liability insurance has increased 12% year over year for the past 3 years.
Oh, wow.
What do you think his rent growth is doing year over year?
That's what
In Mississippi, it ain't growing 12% year over year. So you're basically looking at a deal where I grew up underwriting property insurance, just property and liability, around $500 per unit per year. That was kind of like my rule of thumb metric, and I can kind of go through my cheat sheet on like what I estimate expenses to be if I have no information. But like $500 per unit per year was kind of like the standard for property and liability alone. I also brokered in a market which was on the water, so it was coastal, so Hampton Roads, Virginia. So I also had to factor in flood, hazard, and in some cases wind insurance on top of that property and liability. So it was not uncommon for me to see $1,000 per unit per year insurance cost alone. I love the fact that he has $350. Another fun fact, whenever you see a round number on a Proforma, it's made up. It's made up. So $350 per unit is exactly what I'm referring to as the broker's estimate per unit per year in cost. That's light, and right now, you can Google it, you can read it, you can track this. Nationwide, insurance premiums are growing year over year at a rapid rate, faster than we've ever seen before. So again, if I'm doing a detailed model on this, I'm gonna have a much more conservative estimate on what the insurance cost would be. And I'm also gonna be adjusting my expense growth to reflect that market reality. Taxes. Did we ever find what this deal was priced at?
No, we skipped that.
All right, don't go back. Let's just say it's $2 million, right? Which actually I'm gonna try to find. What's the name of this deal? Hillside.
Yeah.
Hillside. Hillside. Garden. All right, so this deal, I don't even know if it's priced or not, but I'm sure in a market like Winston-Salem, so $2,040,000. So it's priced at $2,040,000. So again, right now, if they're paying taxes of $15,000 and there's an assessed value of 1.1, let's just call it a double. Like, it's going to double at some point, right? The way to calculate the taxes is the same. It's still based on the same mill rate. It's based on the same, process to arrive at what that property tax will be annually. At some point, the auditor is going to say, "Oh, this deal traded for $2 million." You can't argue it, really. I mean, you paid $2 million for the deal. You can, of course, contest it. That's a process. Yes, you can try that. But at some point, that tax is going to go up. So when you underwrite it and you have no increase to taxes, again, you're eating away at a true NOI. Next, utilities. We'll mark that as whatever. Utilities are what they are. But I will go back to the actual T12 and see what the utilities were. Management fees. So management fees, I like that they have it as a percent of gross potential revenue. Typically, you'll see management fees as a percent of EGI, effective gross income. So if I use that number, I'm just taking 15,596 divided by 195, 492. So 8% is somewhere between 7 and 8% for the management fee. And going back to your question, right? If the owner is self-managing, they might not have any management fee listed. One could argue that, on a deal this size, that's a fair management fee. I mean, 8 to 10% is expected. But that's the conversation that you should be comparing between actual financials and what the market will actually bear. I was looking at a deal here, and the owner was trying to tell me, like, hey, you can get someone to manage this, sub 20-unit deal for 3%. And it's like,
Where?
please refer me to the person. please give me the name and the number of the property manager that will manage this deal that's sub 18 units for less than 6%. 6% still low. I got 3 bids. The best bid I found was like 8%, And again, that's broker math. If I can underwrite it in the package at a 5% management fee, even though I know darn well the buyer is not going to be able to get that, I can make that NOI stronger, and I can still put out great location, prime, market, offered at a 7 cap. Cap rate really should be taken with a grain of salt. Why? Because cap rate is calculated based off of a NOI and a price. If that NOI is not accurate, I mean, you can make a cap rate be whatever you want it to be based on 2 variables, price and NOI, right? So I digress. Administrative, 125. I look at administrative as like G&A, right? Anybody ever done an eviction?
Yeah.
Roughly how much does it cost to do an eviction?
More than 125.
Way more than 125.
Yeah, per unit. So they're saying $3,000 for the entire year. How about preparing your taxes? You guys have investors. You guys send out K-1s at the end of the year. Ballpark, what does your CPA charge you to do tax prep for one deal? Couple grand, right?
It's like $3,000.
Yeah. So when I look at this, again, it's just light. It's light. I don't see them being able to run this deal on, again, round number, $125 a unit, $3,000, in annual administrative expense. So that includes evictions, legal. That might include, any permitting expense, things that you have to pay to conduct business, business license, registration. I mean, you form an LLC with your attorney is probably $3,000, right? Like you form an LLC to buy the deal, you're already a couple of grand in just because of filing paperwork and getting an operating agreement established. Repair and maintenance. All right, so let's stop there and let's pop back to the actual T12. And I'm gonna wrap up, that way I can leave questions, but I hope I'm driving the point home, which is you have to confirm these expenses with the actuals. So repairs. Do you see that right column right there for repairs? We're already higher than what was stated in the package, right? The package was stated at what, 9,500, something like that. So we're already over. Carpet replacement. One could argue if I'm the listing agent, I'm going to go back and I'm going to say, okay, what can I move below the line? Because yes, some of these expenses are not reoccurring, right? So I am going to underwrite to a seller favorable NOI, and I do that by adjusting within reason and being able to defend my assumptions on where I make those adjustments. So I might find a way to just actually remove some of these expenses from the entire underwriting. And then in my package, I'll write that assumption and I'll demonstrate how I arrived at that, at that adjustment. Let's keep on going down. HVAC, yeah, that'll hit you. There we go. New replacement HVAC. So we got another 11 grand. Where's this $9,000 coming in, right? Now again, some of that could be moved below the line. I'm not saying that all of this is reoccurring in like common repair and maintenance, but it does support my point, which is there's no way in the world you can run a 24-unit building and spend $9,500 a month on repair and maintenance, or a year on repair and maintenance. Commission, geez, almighty. So they either bought this deal vacant and like did a gut renovation. I don't know how you had that much in leasing commissions. It looks like it's basically 1 month, leasing commission. So like when I see $1,400 in August, that's probably two units that were vacant that were leased up. But their management company is smacking them, right? Like they're getting, 8% on a percent basis. It's pretty common though. 1 month lease up fees. So it's not outside of the market, but that certainly wasn't represented in the underwriting of a flat 8%. Let's keep on going. Property tax, we already talked about that. Utilities, I see, all right, now I'm starting to get upset. So, dumpster service, right? I would categorize dumpster service as contract services. So you have landscaping, you have pest control, you have trash removal, you have all these things, snow removal, especially for us here in Ohio, probably not in North Carolina, but like, I would look at these expenses and aggregate them as a contract service line item, and I would roll up all those landscaping, trash, as a contract service line item. And now, the good thing is it's variable, so I can defend the seller and say, you know what, I don't know who your cousin is that does dumpster service removal, but we're gonna present to the market that they can get a better deal, and we're gonna adjust this down because that seems high to me, right? But let's pop back one more time. Now we have a pretty good picture of what the actuals look like. Let's pop back to the book, not the broker book, but the offering memorandum. Contract services, they have $7,000, but they're not accounting for probably cleaning. They're not accounting for pest control, landscaping. So again, that's light relative to what we saw in the actual income expenses. Let's pop back one last time, and then I'll kind of show you how I go about all these adjustments. Let's scroll all the way down. So there's $700 in pest control, legal expenses. So oftentimes what we see either one of two things. We see someone taking this NOI of $54,000 and without making any of the adjustments that we talked about, throw a cap rate on it. And I don't know how you do that on this one, because at a 5 cap it's $1 million, right? If you just take the actuals, right? So I just took that NOI and divided by 5, and I got $1,094,000. So if they're priced at $2 million, their NOI is not even matching their expenses, which again, if I'm the seller's agent, I'm going to find a way to adjust to the seller favorable NOI. But we're a long ways away from, last time, pop back to the OM. We're a long ways away from 54,701 NOI. There you go. And 128,000.
So yeah, a question I have around that.
Yeah.
So it's a little too pronged. Number one, at which point, or this is all in PD, right?
Yeah.
Or pre-underwriting before there's an offer, because if people like the basis or whatever, they could be writing offers.
Yeah,
Regardless,
if you're-
regardless of the cap rate, and you're
Yeah.
against a lot of stuff, then all this is kind of pointless.
That's a great point. Let's not breeze over that.
Can you translate
Basis is
that?
forever.
I didn't understand the
Yeah.
question.
So basis is forever. Cap rate is temporary. And so what do I mean by that? In Columbus, if you could buy a deal today in Columbus for 65, 75, 90 a door, your basis is 90 a door in a market that we know and we all believe to be extremely attractive, growing, like crazy and undersupplied. I like that basis, right? I could probably care less if I'm buying it at a 5 cap today. I think the argument could be made that Columbus in certain markets, people are not cap rate sensitive because there is appreciation value that can't be underwritten necessarily with precision.
I'm buying a 3 cap right now. But
Yeah.
it's a pretty, I would call it heavy value add.
Yeah, and that's okay. But you also probably have a business plan to be able to invest heavily in CapEx, grow rents. What are the average in-place rents right now?
Average in place rents it's in German Village.
Yeah.
It's under 600 a month.
Oh, yeah.
So you're double if not more, right? So your business plan, you
I
can,
have it under 900 a door. So they're smaller.
That's fine.
100 square foot.
whatever it is, your business plan, your year one stabilized, you'll probably be, at least north of the market. You'll be north of a 6 cap. I think if you do it right, once you stabilize.
You think you can exit?
Uh,
You think you can exit under 7 cap?
It depends on your extra strategy. I think on a deal, it's a 3 unit.
10.
10 unit. So I look at it as, your business plan should either be to refinance, irregardless of interest rate. Again, you're dating the interest rate. I don't care what the interest rate is. It's temporary. You still want to cash flow if possible, but your exit is probably to recapitalize your initial equity out by refinancing. I think you look at the sale from a cap rate valuation, from a price per door valuation, like what will the market say about your pricing without, stabilization is showing a true trailing history of achieving your business plan.
And to what Tony said, it could be even lower NOI because we literally just have a line expenses
Yeah.
minus gross revenue.
Yeah.
But like he was saying, these old sellers that
Yeah.
are willing to sell.
I think taxes are probably going to be your biggest challenge.
I'm drawing this one.
That's fine. But I still think at some point it's going to catch up. And if it's not for you, and put it like this, even if you flip out, that's fine. If you flip out, that's fine. But like, someone's going to catch the hot potato.
Yeah.
Like, someone's going to catch it.
He's doing a similar one, but it's getting even lower basis. I'm at 70 or he's at 60.
Yeah.
I'm near UA.
I like that basis all day. I mean, like, I'm not worried about a cap rate, underwriting on a deal that makes all the sense in the world with low rents and a low basis, right? But the whole point of this is if you're looking at it and you're taking face value, maybe reconsider. Not reconsider buying the deal, just reconsider how you're looking at the deal. And then just verify the actuals relative to the broker's Proforma. And then also just I've made these mistakes on my own deals, right? Like I've underwritten the 5% standard vacancy. And the reality of it is on most like C apartment deals, you're gonna always be north of a 15% vacancy when you factor in, economic loss. People just don't pay their rent on time as agreed. So that one change for me made me much more conservative. Now, the challenge, of course, in this market, and I say this market because I still think Columbus will have the same challenge, is it's an extremely competitive market. Like if you're underwriting like I just walked through, you're not going to get any deals because someone is willing to pay, in most cases, the price that's pretty close to what the seller's asking. But at the same time, I think we're going to see some of those buyers, the market catch up to them because they did not factor in certain things. I have a couple of buddies that bought deals that didn't know about this whole reassessment thing. That hits NOI. It hits NOI, and it not only hurts you as the current owner. if it hits you, it's gonna hit the next buyer, right? And I mean, that's the one thing where I think property taxes and insurance costs, if you're not being a little bit more conservative on those two, you might get stuck. So I've talked enough. I've kind of rambled for an hour. I'm trying to think if there's anything else that I had in that file. I do kind of have, a quick model on how I compare actuals to my adjusted underwriting, but we'll love for questions and happy to discuss anything.
Is it customary to ask for the seller to hand over reserves?
Reserves?
Like maintenance reserves?
Like handle their actual maintenance expenses?
Mm-hmm.
Yeah, I mean, I think to an extent, but it also depends on the sophistication of the seller, and it depends on the sophistication of, of the buyer, right? I mean, some sellers are not going to be comfortable giving you anything, and you have to be prepared to underwrite based on your own assumptions, and then stand behind and defend your own assumptions, right? So I think that's kind of the art of being a buyer and being a principal in this market. You got to roll the dice sometimes, but you got to roll the dice, wisely. I also think you have to. Everyone has a different strategy. I've never been a buyer to agree on a price, knowing that I'm gonna come down 30% on that price. I lose a lot of deals, right? Because I just don't believe in retrading, without the retrade being warranted. Some buyers have a different philosophy. There's no right or wrong philosophy. I just know, I'm newer to this market. I want a reputation of being someone that goes into a deal and closes a deal unless there's something that warrants a major retrade at or around the price that I went into the deal at. And there's also different layers of sophistication with agents. There's a lot of great agents in this market, right? In other markets, that's why I chose this one. I actually pick deals more on the agent that's representing the owner than I do the actual deal, because I've gotten more deals that way by just out brokering the broker. This market has great brokers, shout out, to you in the back. So, I think it's all about the deal, all about the broker. So,
You mentioned that a couple of your buddies got caught with the reassessment.
mm-hmm.
Are you talking about the drive-by 6-year
I'm talking about just
assessment they do here, or?
in general, because you buy a deal based on a look in the rear view, and if you're not planning for the unknowns, in front of you, think about it. If you underwrote a deal based on a $95,000 NOI, and then your taxes go up by $30,000-$40,000, in some cases you're not even covering debt service anymore. Because what doesn't change? If you do a 7 or a 5-year fixed note, your payment stays the same every single month, right? That does not change. It's the variables that get you caught, right? So in some cases, I have friends in other markets that have bought deals that cash flowed for the first 2 years, and they came up short year 3 because taxes ate away their NOI. What else we got?
Well, when it comes to closing costs, how does that, what's typical? Who pays for what?
It's usually all negotiable. I mean, it depends on the size of the deal. I'm doing a deal right now. It's a 40-acre deal. That was a deal term. That was a sticking point in the deal, was how are we going to split up closing costs, right? On a smaller deal, it may not be as significant. Again, I think it all varies based on the seller's, sophistication, and also the sophistication of the agent that's representing them.
Mentioned before, it's hard to be conservative in underwriting and also get deals in these markets. Is it just a matter of just underwrite a million deals until you find one good one, or how do you kind of still find things with meat on the bone even with conservative?
I mean, this is my general feedback on that. I feel like in any negotiation, you can have one of two things, but you can't have both. You can have price or you can have terms, right? So I think deals that win, sometimes, the buyer accurately assesses the seller's motivation. They accurately, either directly if they're going direct to seller or through the agent, uncover which one of those two things are most important to that seller, and they're able to curate an offer that meets that objective. So said otherwise, if they're hung up on price, like right now, most of the deals that I'm writing on, I will give a seller his price, yesterday's price. But I'm going to ask for terms, meaning if you believe strongly that your deal is worth $1 million, and it truly is shown, the market has shown it's worth $800,000, I'm going to structure an offer where I'll still give you $1 million, but I might ask you to hold, a seller second of $100,000, and that way I'm at least making my personal deal and my yield metrics work, because now I'm kind of like arbitraging the deal. I don't have $200,000 of my own cash in. I only have $100,000 now. Now my cash on cash return is manipulated to be a little bit stronger. Like, that's how I'm kind of doing deals right now. And I feel like it is a good strategy because, some sellers are still stuck on price, and they're now more willing to give terms. The other way to do it,
Is that what you said?
a seller second, yeah.
That is?
Yeah, so if I buy $1 million deal and I go to the bank, and 80% may be possible still, but let's just say it's 70%. To buy that deal, I need $300,000 cash, either of my own or I need to go, partner and raise. But I need $300,000 to buy that $1 million deal. So if I go get a loan for $700,000 from a bank, I can bring $300,000 of my own cash to the deal. But in that scenario, I might ask the seller for $150,000, and I'll frame it in a way where I'm saying, hey, you're still gonna get your money, but you're gonna get all your money except for $150 deferred. And I use that word intentionally because the loan is gonna give him money at closing, right? He's gonna get money at closing. So it's not like he's gonna just wait forever to get paid, but I'm gonna try to structure it to where maybe he has $150 of skin still in the game that I can then use as part of my down payment. So instead of me having $300,000 of my own cash in the deal, I have $150 of my own, and then maybe $150 of the seller's equity that he's leaving into the deal, deferred, and then we negotiate when he'll actually get that remaining $150. So if he's stuck on price or she's stuck on price, I might be the only buyer that's willing to give them that price. But I'm asking for terms. I don't know if I answered that question at all, but the other way, of course, is to underwrite a ton of deals and then let the market do its thing. I mean, I like deals. I like a lot of deals in the market right now that are on the market. I like them at a certain price. I will be that squeaky wheel when I see that deal that's still out there, and it hasn't sold. What's great is when they go to contract and then they go back out, and they go to contract and they go back out, and they go to contract and they go back out. Like, at some point, the seller might decide to meet the market. I'm usually glad that I'm not the listing agent on those because I know what it feels like to have a seller that's not willing to meet the market, and it's tough. But two things if you want to get on the good side of brokers. If you are begging for a deal and they give you an opportunity to underwrite and offer on a deal, thoroughly underwrite the deal and share your work. Like, show your underwriting, because then you can at least have a conversation with that listing agent about how you arrived at value. So never just go dark on a listing agent. That's the worst. People will blow you up. Give me a deal, give me a deal. You give them a deal, and they don't even underwrite it. Or, they don't give you feedback that you can then use to manage your client's expectations. Because we are in the management of expectation business. Brokers don't set pricing. Surprise. Like, I don't go out here and say this deal is worth $4 million. The market determines the value, and my job as a broker is to create a competitive environment that cultivates an auction-style environment that lets the market do its thing. So the best thing you can do is respond to your broker or to the broker when they bring you a deal, underwrite the deal, and then share your work.
Math class.
Yeah, I mean, just share your work. You'd be surprised. Like, I do a 10-year discounted cash flow model on like a 4-unit. I don't care. And then I'll explain my offer as to why I couldn't get anywhere close to the pricing. And then they'll laugh at me, but I'll be like, but I bet you one thing, no one else did a 10-year model on a $400,000 4-unit. I bet you that. So at least I still have credibility with the broker, even if the pricing is totally off. And normally when I underwrite a deal, they really can't argue much on my approach to underwriting. All right, y'all.
Any other questions?
Can you speak a little bit to the last deal you bought?
Yeah.
What you bought it for, how you financed it?
Yeah. So I have a deal right now under contract that I like a lot. It's a 40-unit deal. The last deal that I bought was a 7-unit in Cleveland. It was 3 out of the 7 units were occupied. It was listed at 405. The exact blueprint that I gave. Actually, this deal I did 100% seller financing. It sat on the market. No one was biting for 2 reasons. 3 of the 7 units were occupied, and of those 3 units, like 1 was paying. You know, so like it was a deal that my angle and my leverage with the seller was, hey, look, you're gonna have a hard time getting someone to buy this deal who's not buying it all cash because it just doesn't support a loan. So she had high equity. She had owned it for many years. She was mismanaging the property. Clearly, she just didn't have a strong financial track record or history to show a buyer. So I negotiated based on that same model. She was stuck on price. You want price? That's fine. So I gave her the 405 price. I did retrade her during the end of the process because, you know, I didn't know that only 3 units were actually occupied. She showed a rent roll that had 5 out of 7. I didn't know of the 3 that were occupied, only 1 was paying rent. So I did retrade. You know, I found all that out during due diligence, right? But the terms I negotiated a 24-month seller finance note. It is interest only, and I have a 24-month balloon. So basically what I did was I bought myself control of that asset for 2 years with a business plan to vacate, which I did in the first 2 months, and then renovate, stabilize, and then I'll be able to either refinance her out prior to that 24-month balloon, or you know, I won't be able to sell it in this market. That was an option, and I like to do deals where I have multiple exits, but that exit is now, I don't believe, on the table still. So right now, I just have cheap carrying costs. It's like $2,800 per month. You know, it's basically a hard money loan that I didn't have to go to a bank for, and you know, I have control of the asset. My business plan was to either do of those 7 units 2 as short-term rentals to increase revenue, or if I take the other 5 units just to market. She had average in-place rents of like $450. They're all 1-bedroom, 1-den units. I think conservatively, I thought I could get $950. I might get $900. I scaled back my scope of work because, again, I'm a little not bearish, but I don't want to over improve the deal right now in this market as the interest rate environment has, in my opinion, on a deal like that is very interest rate sensitive, right? Because cash flow is very thin on a deal of that size, especially when you have at this point, a 200 basis point increase in the cost of capital since I started to underwrite that deal. So for both scenarios, for me as a refi exit, as well as for me to sell it to someone to go get market debt and actually still be able to cash flow, and then me be able to sell it at a price that I still make a proceed. So my deal, I'm gonna own that longer term, and I have a clock that's ticking, but you know, that's why I didn't do a 12-month term on the note.
Any other questions?
Yeah, so where do you see kind of the debt market heading, given all the headlines we've seen recently with SPV, signature, all that? I mean, you think it's gonna be harder to get some of these loans for multifamily?
I mean, right now multifamily is still pretty, solid as collateral. I think what we've seen, of course, is we've seen a lowering of leverage. So, what could be 80% LTV is now pretty common at 75, maybe even 70, depending on the collateral. Coverage ratio, that's the other thing, right? Like when I model out, you might want to bring up, there's an Excel file in that folder. It should be like sample deal analysis. It might be in that Google Drive actually. Julie, do you know where?
The Excel's over next to the actual.
Okay, yeah.
Right next to the photos.
Right next to the photos?
Yeah, you're right.
Oh, yeah,
You're
X.
right on it, yep.
There you go. Did we ever open up that sample deal? I'll talk through it. I'll talk through it while she pulls it up. But like, so one thing that I have to underwrite to now is I underwrite to the debt, right? So like, I know a lender is going to underwrite to a certain debt coverage ratio, which means, you know, historically 1.2 or 1.25 is what the lender wants to see as free cash flow that's available to cover, you know, debt service. So if my debt service for that year is $100,000 annually, yeah, perfect. If my debt service is $100,000 annually, they want to see an NOI of at least, you know, $125,000. That's simple math calculation for debt coverage ratio, right? So any deal that I'm underwriting, I'm not going to just underwrite it to my own return metrics. I'm going to underwrite it to, is this deal bankable, right? Like, can I get a loan on this deal? So if I can't do a 1.25 coverage ratio, I know the deal probably won't work for me or for another buyer. So that does give me some leverage in negotiation, because a savvy listing agent, I can explain and walk this through like, hey, look, like you're asking this, but like, are you expecting cash offers? Because like it has either, now we can talk about bridge debt, which we saw blow up, right? And we saw a lot of people who got too dependent on short-term bridge financing to do deals, who now, you know, what's the saying? The roosters come home to roost or something like that. I don't know.
Yeah.
But yeah, that's exactly what's happening, right? Like you bet on bridge debt that's short term and not fixed, and now you had a deal where you might have been cash flowing, but because interest rates have moved, now you're negative cash flow, so you're paying out of your pocket every single month. In short, if I can still underwrite to a coverage ratio and then debt yield, I'm just going to look at debt yield, which is basically what's their return on their money. Most lenders still want like minimum 9% debt yield, which is basically like, again, their return on that capital. So I'm going to calculate debt yield in my underwriting as well. And then I'm going to look at the takeout. Takeout meaning any lender is going to look at a deal and say, how do I get my money back at the end of year 5, 7, or 10, or whatever the term is? So I think the debt market is still stable for multifamily. I think coverage ratios might still be more conservative. And what I've seen on deals that I've done myself, if the appraised value for an asset is a as is going in 5.5 cap, the lender is being more conservative in underwriting an exit at a 50 basis point increase above the current cap. So said otherwise, if I'm buying this deal right now, the reversion cap rate might be a 6.5, which means the NOI at the end of the term of that loan, if the value at a 6.5 cap based on that year 5, 6, or 7 NOI, that's what the lender's going to base out their takeout scenario on. So they're going to look at, how do I get my money back, and can someone take me out of this loan at the end of year 5, 6, or 7? That is a variable that becomes more constrained from loan proceeds, and that's what actually blew up a couple of my deals, is that the lender just couldn't get comfortable with the takeout. And the only way for them to get comfortable with the takeout is to give you less proceeds up front. So
Why not get Fannie Freddie FHA long-term fixed rate debt?
yeah, I mean for small balance like agency debt, yeah. So that's an option, right? I still think most deals of this size are being done with bank debt. Agency is always a great option if you A, have the balance sheet for it, and if you B, have the patience for it. But yeah, agency debt is always a great option. But small balance usually goes to a local bank. Those banks are still usually 5, 7, 10-year term. And some of the most accretive financing right now is also through like community banks. So it really depends on your business plan, right? Like if you need your plan to have a certain interest rate to be able to cash flow a certain return, then agency is a great option. But for execution and speed, sometimes you got to go with bank debt. Anybody else? All right, guys. Well, before we close out, thanks for having me. I really enjoyed this stuff. I could literally talk all night about it. We'd love to meet with you. So if you have some time, come say hello. If you're looking to get into multifamily brokerage, we have an office here. I'm leading it up. I'm starting it. So come see me. And if you have a deal to sell, I am in the market. I want to buy it.
All right, thank you, Max.